We're going to go ahead and get started. I wanted to welcome those that already attended last week's session. It was on investments. It was awesome. Thank you, Shahar, for sharing the information with us. And a very fine welcome goes to the new participants that have not yet joined last week's session. And so you'll be able to participate today. We are going to be having a Q&A at the end of the session. So we've incorporated time into that. So the session will run about an hour and 15 minutes, and then we'll from 5:15 to 5:30, we'll incorporate the Q&A. But again, I wanted to introduce myself. My name is Debbie Johnson, and I am from the Johns Hopkins Federal Credit Union. And we've kind of joined forces with the Postdoctoral Association, the PhD and graduate groups that wanted to put together a financial series for the students and the postdocs. So this is kind of a three-part financial series. And then we're going to be talking about taxes next week. So definitely visit again next Wednesday. And then for those who did not attend last week's session, Shahar is an experienced educator, writer, and has vast experience teaching personal finance at some of the leading universities in the US as a speaker. And Shahar, I did get this from your website because I thought it was awesome. Shahar is skilled in simplifying the complex, sometimes intimidating world of personal finance. So I think we can all agree that Shahar did a fantastic job last week explaining the intricacies of investing. So I know we're looking forward to the session today on retirement and the tax session next Wednesday. So Shahar, go ahead and take it away.
Awesome. Thank you, Debbie, and thanks to the Johns Hopkins Federal Credit Union for the ongoing partnership. I think it's amazing that you're helping to kind of bring this type of content to the university across all different kind of levels. So hi, everyone. Thank you for taking time out of your Wednesday afternoon or kind of evening to join. I'm really excited to be here to talk about essentially saving for future you and kind of thinking about retirement. A couple just upfront housekeeping pieces. My email is there. If you have questions after the session, something that you didn't either feel comfortable asking during the session or something that hit you later, feel free to send me a note. I'm happy to respond. Number two, as Debbie mentioned, we'll leave time at the end, dedicated time for questions. But if there are things that come up throughout the session, please do use the Q&A button on Zoom. I'll see those questions and I will do my best to incorporate answers as we go along as well. Since the start of COVID, I've gotten fairly good at kind of managing both, kind of presenting, but also kind of monitoring the questions, the fun of working in a virtual world. So please do feel free to ask questions during the session as well. And I'll answer a lot of them. If for some reason, I think it's better at the end, I'll probably just punt it towards the end of the session. As Debbie mentioned, this is the second part of our three-part kind of series for the academic year. Last week was all about investing, how to build a portfolio, whether you should do it alone or get help. Today is all about retirement. There's a little bit of an intersection between retirement and investing. I'm going to kind of cover a couple slides, I think only two that I used last time, but I would encourage you, if for some reason you didn't attend last week's session, to watch the recording of that session. I think it'll help and really be a good complement to retirement. And then next week, as Debbie mentioned, we'll cover taxes. Taxes is often the most highly sought after topic for graduate and kind of postdoc students, just because the intricacies of filing your taxes in the US for grad students is pretty complex. There's a lot of them. What counts as income, what can actually offset income, things like that. So there are a lot of different components within that. And on the retirement side, this is just a list of topics in a survey that was done nationally of topics that are in demand. We hit investing, we're going to hit retirement today, and we'll hit taxes next time. I see someone, somebody asked, is there a way to access the talk from last week? Yes, I believe that Raven and I think Raven sent out a link with the recording. And if you didn't receive that, you may want to reach out to Raven or to Debbie. And I'm sure that they'll be happy to pass along the link to the recording as well as potentially a PDF of the slides. All right. Thank you for that question. So just a couple of kind of upfront slides, and those who were here last week, just bear with me. I want to make sure everyone is grounded. Setting expectations, you may know one or two of these people. Warren Buffett on the left, the founder and kind of CEO of Berkshire Hathaway. And on the right, Melody Hobson, she's the CEO and the chairwoman of Ariel Investments, two of the most successful investors and kind of financial service people that I know. In the 90 minutes we have together, I cannot turn you into either of them. So really the goal here is to start to build your financial toolkit. Last time was investing. Here we'll focus on building the retirement section, giving you some facts, but really focusing on insights and strategies that you can apply right away, and that will help you both in the short and the long term as you're thinking about how do you set yourself up for financial success. But just to give you kind of the caveat that we will be scratching the surface, we'll be doing more breadth than depth on this. We could probably do a week on retirement alone and a week on any of these topics, but really this is meant to kind of give you that primer to start with. First question all of you should be asking is, why should you listen to me? I've been doing this for a long time. About 10 years ago, I founded a personal financial management program at Harvard. Since then, I've expanded to work with a lot of other universities and a lot of other employers. Notably on this list, I'll say is for the past 6 years, I've been doing work at Columbia with their Graduate School of Arts and Sciences, which is all their master's and PhD students. So I am fairly well versed with the types of concerns and the questions that master's, PhD, and postdocs have. So wanted to lead with that background. I also, I think, know what a lot of you are going through, or kind of can relate in many ways. I moved to the US when I was 3. We came for my dad to pursue his PhD. He's a professor. He teaches at the moment. So I grew up in an academic family. So we can relate on kind of several dimensions. Most importantly, though, is the bottom one, which is I am probably as objective as you're going to come, around these topics. I'm not affiliated with any financial services company. I work for PayPal. It's a fintech company. You won't hear me talking about it at all for the rest of the presentation. I'm not trying to manage your retirement portfolio or your investing portfolio. I can't do your taxes. I'm not recommending any products or services that I get money for recommending. So essentially, I have few or no conflicts of interest. And I always like to start with that, as those who heard last week heard me say, because you really, when it comes to your finances, the first question you want to ask is, who is this person, giving me advice? What's in it for them? Do they have any ulterior motive? Do they have any conflicts of interest, or are they giving me the best advice possible? A lot of people out there will want your best interest at heart, but unfortunately, there's a lot of people who have conflicts of interest and will give you okay advice, but may have something else kind of in it for them. So I always like to highlight that as a starting point. So let's jump into content. Some of you may have heard this, what I call myth about the sale of Manhattan, which was in the 1600s. Peter Minuit convinced the Wappinger Indians to sell Manhattan Island to him for $24. And people always talk about this around, what a steal. They got it for so cheap. And I guess my question is, who actually got the better deal? Well, if you value all of the land in Manhattan, this is from a year or two ago, comes to be about $1.4 trillion. I guess the question is, what would happen to that $24 if it had been invested in a stock market? And realize that the NASDAQ and the Dow didn't exist back then, but assume that that money had been invested the way that we could invest today in the stock market. How much would $24 be worth from the 1600s? And the answer, if it grew at about 7% a year, is it would be worth over $8 trillion. So, I don't think the Wappinger Indians were able to invest it back then, but if those were done at equal times, the values look a little bit different. And my point here, and one that I'll demonstrate with my next example too, is your money can grow very, very quickly. Look how $24, granted, it's about 400 years, a little less. $24 grows to $8 trillion when compounded at 7%. Maybe a more relevant example, I'll give you a story of two savers. Imagine saver A, let's say maybe someone who just finished undergrad or grad school, decides, you know what, I've been studying for so long, I'm just going to go on a binge. I'm going to party for 10 years. And after the 10 years, opens up a retirement, a tax-deferred account, and that account earns 10% each year. And let's say saver A invests $2,000 a year for 30 years. In other words, over that 30 years, they're putting away $60,000. And you compare that with saver B, who maybe took this workshop and decides, I'm going to open up the retirement account right away. It's going to earn the exact same amount. And instead, though, this person is investing $2,000 a year, but only for 10 years. And then they save nothing. In other words, this person only contributed $20,000. Let me ask you, let me cue up the poll here. Who do you think has more money at the end of the 30-year time frame? Saver A or saver B? Give folks a couple minutes. All right, I should cue the Jeopardy music with this. Maybe I'll add that for next time. All right, 5, 4, 3, 2, 1. All right, I'll share the results with all of you. 2 to 1. Preference for saver B. I would say that those 2/3 are correct. So saver A, you can see the math here, and I gave a little bit of it, starts with $2,000, and you can see the total, and I did it in kind of 5-year increments, ends up having $361,000. Saver B, even though they're only putting in $20,000 and not doing anything, ends up with $620,000, close to double, not quite, but close to double. So for those who kind of attended last year, this is the same principle as what we did with the penny, but a slightly kind of different example. This is essentially called the time value of money. Money starts to grow exponentially, and the money that you put in not only gains money each and every year, but then the money that you actually earn grows on top of itself. And that leads to this exponential path for growth. And really kind of the concept here is that even if you start early and put in a little bit and then stop, you actually can end up with more money than someone who delays saving for retirement and then puts in even more money. So to help illustrate this concept, I'm going to just stop sharing for a second. I'll share the other piece. I'm going to share a clip from one of my favorite shows in the past. Let me just go here. Where's my file? Come on. Here we go. This is from Seinfeld, and I was just debating with Debbie and Raven whether Seinfeld resonates with a lot of you. So hopefully some of you have heard of Seinfeld or seen it. If not, hopefully the concept will still hold, but let me put this out.
Mom, again with the ketchup. Don't they have them in the plastic squeeze containers? Jerry, hello.
Hello, Uncle Leo.
What are you doing here?
Nana called me to open the ketchup bottle.
Yeah, me too.
Hello, Jerry.
Hi, Nana.
Aren't you going to kiss her hello?
Yes, of course.
Oh, well, here's the bottle.
I'll do it.
What are you doing? I got it.
Give it to me. Will you stop it? Jerry, would you give me the bottle?
Uncle Leo. All right, take it.
You should let Buddy open it.
Buddy, he lived next door to us 45 years ago.
Leo, did you give Helen the $50?
What $50?
Your father won $1,000 at the track last week, and he gave you $100, and you were supposed to give $50 to your sister.
Ma, Dad died in 1962. Oh. Believe me, I don't owe your mother $50.
Hello? Oh, hi, Mom. Yeah, I was at Nana's yesterday. I had to help her open that ketchup bottle. Hey, Mom, let me ask you a question. Do you remember when you were a kid, your father winning like $1,000 at the track? Really? Did you know he gave Uncle Leo $100 and he was supposed to give you $50? How do I know? because Nana doesn't know what year it is and she thinks this just happened. Well, I think you should. Okay, bye.
Do you know what the interest on that $50 comes to over 53 years? Please. $663.45. And that's figuring conservatively at 5% interest over 53 years, compounded quarterly. Or if you put it into a 10-year T-bill...
Woody, will you stop it?
Well, he's not getting away with this.
All right. So one of more personal finance related clips from here. Let me just come back to the PowerPoint. So what did Jerry Seinfeld's dad calculate here? Just open this up. So what he was essentially saying was, you know, $50 and he was growing at 5%. I'm going to do yearly compounding just to make it easy. But you can see how the money starts to grow pretty slowly at the start. You know, you're adding $2.50 and then $2.60. But then all of a sudden, it really starts to kind of add up more, and you end up with, in this case, $600. So just another example of kind of the power of compounding. And let me just share a simple rule that can help you as you're thinking about, you know, retirement, which is known as the rule of 72. And if you want to kind of estimate how long it's going to take for your money to double, you divide 72 by the rate of return or the interest rate that you're going to earn. And that essentially tells you how long it's going to take for your money to double. So intuitively, of course, the higher your yearly rate of return, the fewer years it's going to take for your money to double. So you can see that if you were, earning 4% a year, then it would take you 18 years for your money to double every single time. But if you were actually earning 12%, it would only take you 6 years for your money to double. So it's a handy rule of thumb. It's not a precise kind of calculation, but it is helpful to think, wow, if I'm earning 6-7% in this number of years, it's going to kind of double for me. So I know I'm kind of beating this point home a little bit, but to me, this is one of the most fundamental takeaways from this entire workshop. And I always like to kind of start with that, which is the earlier you start saving, the less you potentially have to put away. You're giving your money more time to grow for you. And similar to Saver, kind of Saver B, who started saving early and then stopped, you actually can end up with a lot more money. And so the line that I always say is time in market, in the stock market, is as valuable, if not more valuable, than the amount that you're putting in. So key takeaway here is if you have already started saving for retirement, great. If you haven't, not a big deal. You have many years ahead of you, but I would make a concerted effort to start saving this year, if you will. Okay, so let's talk about what that looks like and what saving for future you actually means. So one is, I like to start with, why is this even so important? Well, number one, risk has shifted over the past decade or two from the government and employers to individuals. Your parents, grandparents, you may know a lot of people who have pensions or had pensions in the past. And pensions are very different. They're basically called a defined benefit plan, meaning you would work a certain number of years and then you would get paid a set amount of money every month until you passed away. That's pretty secure because you know that you're guaranteed to some extent a certain amount of money coming in every single year. Nowadays, there are still companies or the government still does offer pensions, but for a lot of people, they don't have any more pensions. Instead, they have retirement accounts, things like a 401k, and I'll talk about exactly what that is a little bit later. But a 401k or the retirement accounts from today are called defined contribution. Basically, you are responsible on your own for putting money away now to save for retirement. And that's shifting a lot of risk onto you. If you don't save enough, you may run out of money. Number two is there's an uncertain safety net. Your parents, grandparents, others may already be receiving Social Security benefits. Social Security benefits are very similar to a pension. Every single month until you pass away, once you start collecting, you receive a set amount of money. Social Security Trust Fund right now is set to run out in 2035? I don't think it will. There's a lot of adjustments that can be made in terms of the amount that people receive, the age that you can claim, a lot of different variables. So, my opinion is it will probably continue into the future, but I can't guarantee that it's going to continue at the same rate or how much money that you'll get. And so because that safety net is less certain in terms of the amount that you would get or whether it will exist, makes it even more important for each of us to take ownership and save for retirement today. Thirdly, life expectancy is rising. That's fantastic. Hopefully all of us are living much, much longer. The other implication, though, tying into the first one, is you not only have to save for your own retirement, but you have to save for potentially a much longer lifespan. Means it's even more important and incumbent on everyone to start putting money away. And finally, the nature of work is changing. In the past, most people had full-time, jobs. They worked at one employer. Maybe they worked at one employer for 30, 40 years. Nowadays, people are job hopping much more. A lot of people aren't working, full-time at one company. Some of them are, participating in the gig economy, have several different jobs or freelancing. And that has implications into the types of retirement accounts that you have, and also the need to start saving. For example, for a lot of people who are working at a company, it's very easy sometimes to be able to direct contributions into a retirement account. But if you are participating in the gig economy, you don't have access to employer-sponsored accounts, and you may need to, kind of take more steps to actually set up accounts for yourself. So a lot of these, I think, are kind of changes that have been happening over the past, few years, or if not longer, that are really important to kind of have, in the back of your minds as you're thinking about saving for retirement and the need to start saving early. So when I talk about retirement buckets or different accounts, what do I mean? There's two main types of categories of accounts. One is employer-sponsored accounts. When you hear things like a 401k or a 403b, 557, those are all accounts that you have access to through an employer that you work with. And that can be a private company, it can be a university, it can be the government. Each of these accounts is designated for a different type of kind of industry. But what they all have in common is if you work for an employer, you will oftentimes have access to one or potentially more of these different retirement buckets. The other category though is something called self-sponsored options or a bucket. And these are ones that you can open up independent of any of your work situation. So you could be completely on your own, working on your own, not at a full-time employer, and still open up something called an individual retirement account or an IRA. Or there are kind of other options for folks who are engaged in the gig economy, like a solo 401k, et cetera. So I talk about both of these, but these are kind of the two main categories of different buckets that you could find. So the main difference between some of these, and essentially the word Roth is the main difference, and I'll show some examples right after this. The government, in most cases, wants to incentivize people to save for retirement. And one of the ways that they do this is by providing tax incentives. Now, they provide tax incentives in two different ways. With some of these accounts, like a 401k or an IRA, those are essentially called pre-tax retirement accounts. And the reason is you're allowed to put money in before you pay taxes on the money. And the benefit of that is that you don't have to pay taxes right now. You can actually have more liquidity in your budget because you're not actually, paying money to the government. Now, what happens with a pre-tax account, though, like a 401k, is you don't have to pay taxes when you're putting money in. But then in retirement, when you start to withdraw the money, the government still wants to collect taxes. And so you pay the money when you withdraw funds in retirement. A Roth account, and this is any type of Roth, a Roth IRA, Roth 401k, is the exact opposite. You put money in after you paid taxes on it, but then the money grows and you can actually withdraw it in retirement tax-free. So really the main difference between any account that has a Roth in front of it and ones that don't, that are pre-tax, is essentially the timing of when you're paying taxes. Are you paying it early or are you paying it in retirement? And I'll give you some guiding principles in a little bit on how you should think about favoring one or the other, or essentially using both. So here's a quick overview of retirement buckets. And I'm going to spend a few minutes walking through this because I think it's important for everyone to understand. So the two main accounts that you may get via an employer are a 401k and a Roth 401k. We talked about the different tax advantages. A 401k means you put money in pre-tax. A Roth means you put money in after you pay taxes, but you can withdraw later. The nice thing is that on employer-sponsored accounts, there are no income restrictions. You can make $10,000 a year, you can make $100,000 a year, you can make $1 million a year. There's no difference in terms of, there are no restrictions based on your income level for how much you can contribute. There are yearly limits to how much you're allowed to contribute to these accounts. And right now it's about $19,500. One thing to point out, this doesn't mean that you can put $19,500 a year in a 401k and another $19,500 in a Roth 401k. The $19,500 limit is across both of those accounts. So you could put $10,000 in a 401k, $9,500 in a Roth 401k, that's fine. But you can't exceed that $19,500 limit across both of those. If you are over 50 years old, you are allowed an additional $5,000 called catch-up contribution across both of those accounts as well. On the individual account side, I talk about IRAs and Roth IRAs. These are slightly different. There are restrictions based on your income in terms of whether you can contribute and whether you can actually deduct the amounts from your taxes. So an IRA, there's no income restriction on kind of making contributions, but if you earn above a certain amount of money, and I'll show you those numbers on the following slides, you may not actually get a tax deduction for the money that you put in. With a Roth IRA, there's actually an income restriction on whether you can even contribute to a Roth IRA, and I'll show you those as well. Now, the contribution limit for these is $6,000 a year. So you can see it's much lower than the employer-sponsored accounts, but those are independent. You can contribute $19,500 to a 401k and $6,000 to an IRA, provided you're eligible. And then I also just gave an example at the bottom of something called a SEP IRA, which is available if you have kind of money from, I call it kind of 1099 money, which is from a side hustle or a gig economy job. There, the government basically says, oh, well, if you're kind of working on your own, you're your own employer, if you will, we're going to give you access to potentially a higher amount to contribute. And you can see that you can contribute potentially up to $53,000. But they say there is a limit. And so it's actually the lesser of $53,000 or whatever income in a year, 25% of that, whichever one is lower. So with that, let me walk you through the intuition of how this works when actually calculating the benefits. And I'm going to get a little bit into taxes just by showing you the income tax calculation. We'll go into this in a lot more detail next week. But essentially, the way income taxes are calculated is you start with gross income, the amount you have coming in. You make different adjustments, and that gets you to something called your adjusted gross income. There are all these different types of things that can be deducted. And after that, you get to what's called your taxable income. And when you multiply that by the tax rate that you have to pay, that gives you the amount that you owe in taxes. When you subtract that, you have your leftover amount. And then there are different amounts that you can put in, post-tax. So IRA contributions hit at the top. You basically move that or subtract that money from your gross income before you even calculate, taxes. Roth IRA contributions, post-tax, happen after you've already calculated tax liability and the amount that you have left over. So let's bring this to life a little bit. Let's say you open up an IRA and other person opens up a Roth IRA. On the IRA side, let's say that you had $50,000 in income and you contributed $10,000 to an IRA. That would be adjusted here. You would subtract that out. Your adjusted income would be $40,000. And let's say that your tax rate was 15%. You would owe about $6,000 in taxes. You would have $34,000 left over. So at the end of the day, you have $34,000 in your bank account, $10,000 in your retirement account. If you did the same thing on the Roth side, let's say you wanted to kind of have $10,000 in the retirement account, then what would that mean? Well, here, there's no adjustment pre-tax because it's a Roth account. So you would take the $50,000, we would calculate the tax rate, let's assume it's the same 15%. You would owe more money on your taxes, partially because we haven't deducted the $10,000 here. So you'd owe $7,500 in this case. So in this case, you have $42,500 left over. Now you make the $10,000 contribution. So at the end of the day, in this case, both retirement accounts have $10,000, but you see that you have less money in your bank account if you contributed post-tax in kind of in the Roth IRA situation. So let's say you wanted to do something different. Let's say you wanted to have the same amount left over at the end of the day. On the IRA side, let's assume this is the exact same calculation. You want to have $34,000 in your account, in your savings account, $10,000 in your retirement account. But let's say you wanted to do the same thing in the Roth situation and have $34,000 left. In this case, I did the calculations. You'd only be able to contribute $8,500 to your retirement account to keep these accounts at the same level. So in theory, you now have less in your Roth account than in your IRA account. Now, does this mean that an IRA is better? Well, no, because remember, you have to think about also what happens when you withdraw the money in retirement. So let's look at that. Let's assume this is just carrying over. We said we have $34,000 and then you have $10,000 in your IRA, $8,500 in a Roth IRA. Fast forward 30 years, assume your money grows at 7%. Well, you would have $76,000 in an IRA and about $64,000 in your Roth IRA. But remember, when it comes to the Roth IRA, you've already paid taxes. You don't have to pay any taxes on it. On the IRA, you still have to pay taxes. Let's assume it's that same 15%. Guess what? The fact that those numbers are equal is not a mistake. Assuming equal tax rates, there is no difference between putting money into an IRA versus a Roth IRA. It's just a matter of when the taxes are taken out. And I know the amounts look different in terms of how much you pay in taxes, but that's because the money is essentially growing. So does that mean that IRAs and Roth IRAs are equal? This is a stylized example, and there are a couple of variables that I forced to be the same here that may change for you. So, and I'll cover those in one moment, just to kind of sum up a little bit. I do want to share the threshold that I spoke about, and this is for a Roth IRA. It shows if your adjusted gross income is within certain ranges, whether or not you can contribute and how much to to a Roth IRA account. And basically what the IRS does, let's focus in on the single kind of bucket, is basically says if you make less than $125,000 or your adjusted gross income is below that, you can contribute the full $6,000. There's something called a phase out, which says if your income's a little bit higher, we're not going to prevent you from contributing, but we'll say you can't contribute the full $6,000. And the IRS has kind of a calculator that shows how much you can contribute. But what they're saying is if you make more than $140,000, or if your AGI is more than 140, then you're not eligible. And it's a slightly kind of different scale for married filing jointly. Same kind of same concepts on the IRA side. You can see that you have kind of different limits on what you're allowed to contribute in order to get the tax deduction. So one question that often comes up when I'm talking to graduate students or postdoctoral students is what counts as income for retirement? And it used to be in the past that the only thing that counted was money that you received essentially on something called a W-2 or kind of in a 1099. And for a lot of students, they received stipends, fellowships, scholarships, and those prevented them from contributing to retirement accounts. In 2019, there was kind of the Graduate Student Savings Act that passed. And what that basically said is that as of the 1st of January 2020, we're well past that, they basically changed the definition of what counts as compensation. And they changed it to be much more favorable to graduate students. And I'll save you the kind of legal analysis on it, but the implication at the end of the day was that all income that graduate students receive, or things like stipend, fellowships, and scholarships, all of those count as income and would allow graduate students to contribute towards retirement accounts. This is really, really good news. Before, students would get confused. It's like, I received money, why can't I contribute? All of that now is gone for graduate students. So any money that you're getting as a stipend, if you're kind of a PhD student or a postdoc, all of that counts as income. And that what it means is it enables you to save more or even start saving earlier for retirement. So coming back to my kind of question around, are Roth accounts and regular accounts the same or not? Well, a pre-tax account like an IRA or a 401k does provide you more liquidity upfront. And let me just go back to this example for a moment. You can see it actually here. Let's go back to this one actually. You can see that when you contribute $10,000 to a retirement account, if you contribute to a pre-tax account, you have, in this case, $1,500 more than if you would put money away into a Roth. So if you're on a really tight budget, you may need that extra liquidity. And so a pre-tax account gives you that additional buffer while still saving for retirement. One of the downsides of a pre-tax account is that it is subject to something known as a required minimum distribution requirement, an RMD. And basically this is the government saying, we're giving you a break on paying your taxes up front, but we're not going to let you do that in perpetuity. At some point, we want to start collecting our tax dollars. We need the money. And so basically the government created this RMD requirement, which says after 70 and a half, we will use a statistical program based on the amount that you have in a pre-tax account and our modeling on your life expectancy, and you will be forced to withdraw a certain amount of money every single year. And that money will be taxed. And that's really the government's way of saying, of ensuring that's receiving a constant revenue stream. A Roth account doesn't have that additional liquidity up front, but it does provide a lot of tax-free growth. And it's not subject to required minimum distribution requirements while you as the account owner are alive. The other way to think about this is around, which one gives you kind of a better return on your investment. So think about it this way. If you are not at your peak earning right now and are earning, a good amount of money, but maybe not as high as you think you will, your tax rate is probably a little bit lower than it will be. And maybe it's lower than you think it'll be in retirement. And so if your tax rate is lower now than you think it will be when you retire and start withdrawing money, you may benefit from putting money into a Roth account because you're paying a lower tax rate on that. Conversely, let's say you reach your peak earning years and you're earning more than you think you'll ever have to withdraw in a year in retirement. That would be a situation where you may want to defer paying taxes because you're in a really high tax bracket right now, and you actually want to wait till later when you're in a lower bracket. So that's one consideration, your kind of tax bracket right now versus what you think it will be in retirement. Obviously, that's really hard to know, but just giving you kind of the framework for now. The second thing to consider is, what is your view on overall tax rates in the US now and in the future? Also very hard to know. If you think that tax rates are only going up in the US because we're spending too much, the government's spending too much, and they're gonna have to cover more of that, then you may choose to lock in lower tax rates now. Conversely, if you think, I think tax rates in the US are going to go down in the future, there's no way they can stay this high, you may want to defer paying taxes until those are lower. So the two main considerations on there are around your tax rate now and in the future, and what you think about overall tax rates. And then the third would be on an individual level, whether you can absorb the additional liquidity or not. Question came in about the tax for a Roth IRA account. Is it a separate tax that's applied to our contribution after our taxed income from our job? Great question. The answer is no. So basically, think about, you're at a job, you get paid every 2 weeks. Most employers, especially if you're working full time, will withhold taxes from your paycheck and send those directly to the government. And then you essentially get money, kind of deposited into your, checking or savings account. In that sense, like you've already paid taxes on the money. So there's no separate tax on that contribution, but the money that you're essentially getting into your account is already post-tax because your employer has withheld it. So it's not a separate tax. It's basically saying, after you pay taxes to the government, kind of federal, state, local, the money that you have left over to do what you want with. It's a great question. Okay. One other concept here, and I'll cover a few tricks as we go through. Employer match. Many employers will offer you essentially a match on a portion of what you put into your retirement account. And when you get an offer letter or when you start at a job and get kind of a benefits orientation, you may see something like a 50% match up to 6% of your salary. So just to kind of deconstruct that a little bit, assume your salary is $50,000. What that phrase means is that if you contribute 6%, $3,000, your employer will contribute or match, with a match of half of that. In other words, $1,500. And so essentially every dollar that you put in, you get an extra 50 cents up to 6% of your salary. This is as close or kind of, I would call it a guaranteed return on your investment. There is no risk in putting that money in, and you get, in this situation, a 50% return on your investment. I've seen companies that match, 25%, 50%, 100%. Nowhere in the market will you ever see a consistent 25, 50, or 100% annual return on your money. This is as close to free money as you will ever find. It is the equivalent of money growing on a tree. And so I like to kind of emphasize this early on, because if you are lucky enough to work for an employer that does match, it is an amazing way to amplify your retirement savings. In this case, you're putting $3,000 in and you end up with $4,500 right away. And you think about the compounding, it's magical. So my recommendation is, if you are fortunate enough to work for an employer who does offer to match a portion of your retirement contributions, your aim from day one should be to contribute at least enough to get the full employer match. I realize that, especially if you're starting out and maybe your overall salary isn't that high, it's sometimes hard to put together a budget where you can do that. If you can't, at least try to give yourself a line of sight to be able to do it in a year or two. But I would strongly advocate that all of you try to take advantage of the free money that's being offered if you are fortunate enough to work in a company like that. So that's my second kind of takeaway, which is, if you are at a place with a match, contribute at least enough to get that full match. It is an amazing way to just accelerate your savings for retirement. Other question I often get is how much to contribute. This is a really hard question to answer for kind of a general pool, because everyone's situation is different. And like every good answer in economics, the answer is it depends. It depends on your situation and other obligations. Some of you may have liabilities like student loans that may prevent you from contributing a full amount. Some of you may have other obligations, whether it's helping family, paying down debt, etc. I'll give you a couple of rules of thumb that are important. One, contributing something is better than nothing. Even if you can't get to the full amount, even $50 a month is better than nothing and sets you up on the right path. If you asked me to kind of put a gun to my head and said, give me a range, I would say that you want to get to a contribution level of about 10%, up anywhere between 10 and 15%, between the amount of your salary, between what you contribute and what your employer contributes. And so if you have 100% match up to a certain amount, you may have to put in less because your employer is actually giving you more money. But as a rule of thumb, I would say that you want to be contributing anywhere between 10 and 15%, or getting to a 10 and 15% contribution rate overall over the course of a year based on your salary. So for those who are looking for kind of a specific number. And look, I put retirement savings at the kind of base of kind of a hierarchy of financial needs. I think it's really, really important. I put the retirement portion up to the employer match, at the bottom. Each of you can create this hierarchy based on your own personal situation. But when I think about where retirement fits in, even though it's in the future, and a lot of people discount kind of the future in many ways, it's super important to start saving early on for it. So a couple of quick tips. Look, the benefit that most of us have is that right now time is our most valuable asset. We have that 30 years like Save or Be, or kind of the $50 and the one from the track to actually invest and have the money grow. And that is, time becomes so valuable for this. Take advantage of these tax deferred options, whether it's kind of pre or post tax. They just lessen the burden and make your money work harder for you. And what I'll say is that I think grad school, or the early years after graduating, is a really opportune time to use Roth accounts. And I already started to get a little bit at the intuition around that, and I'll talk about that in a second. This is a little bit just on that contribution piece. So here's why I say that grad school is an opportune time. Think about, assume that your salary this year is $45,000. I'm not sure, kind of where a lot of you are. Some of you may be lower, some of you may be higher. Take $45,000. I ran through a calculation of what $45,000 means, and in terms of the amount that you're paying in taxes. And I want to focus in on the federal tax rate. And again, we'll go into this in a lot more detail next week. But basically, the marginal tax rate, the amount that you're paying on, kind of the $45,000 that you're making, is 12%. So if you were to put money into a Roth account, you would be paying a 12% tax on every dollar that you put in. In other words, a dollar would flow through from your employer, you would get, kind of 88 cents, and then you would contribute that. Let's fast forward and let's be really optimistic for a lot of you and kind of what you're going to be doing in the future. And let's say at a future time, maybe it's 5, 10, 15, 20 years, all of a sudden your $45,000 salary becomes $190,000. Guess what? You're making more, you're paying more in taxes. Right now, somebody making $190,000 would be at a 32% marginal tax rate, meaning that on that last dollar that they're making, many dollars before, they're paying 32 cents of that to the government. Think about trying to contribute, even if you could, to a Roth IRA then. Instead of only paying that 12 cent tax, you're now paying 32 cents. So you're actually saving and able to kind of put much more in on the Roth side, or kind of getting a better deal by contributing now. Now, again, some of you may say my salary is going to stay at, quote unquote, a $45,000 range, all along. But if you think that your salary is going up in the next 5, 10 years, earlier is better to put money into a Roth because you're essentially paying less in taxes. So that's the first trick that I always like to tell people, and why I say that grad school is an opportune time to contribute to a Roth. Okay. Trick number 2, and I'm not going to go into too much detail on this, partially just because it gets complex and we don't have the time to go really deep, but I want to make all of you aware of this concept. I'm just going to quickly go back to, let me just quickly go back to my slide here. Okay. Oh, okay. If you remember here, I talked about income thresholds depending on your income. Now, if your income is above these categories, you can't directly contribute to a Roth IRA. But there is something called a backdoor, and I'll going forward to that. There is something called a backdoor Roth IRA, which basically is an indirect way of contributing to a Roth IRA. So let's say, again, you're at that $190,000 income level and you say, I can't directly contribute to a Roth. You can go through a 2 or 3 step process called a Roth conversion, where you basically first contribute to an IRA and then convert that account into a Roth It takes a few steps. There's a lot of caveats and warnings around doing it, but it is a way of essentially getting money into a Roth IRA account, even if you are earning more than the kind of limit to directly contribute to the account. If you are interested in this and in doing this, I would Google. There are a ton of really good guides that walk you through this. One that I'll mention as a favorite, and for no other reason than I think he does a really good job of explaining the intricacies and actually hand-holding you through the process. There's a kind of a blog called The White Coat Investor. It's aimed at doctors or doctors in training. It's applicable to everybody though, and he has a couple really good posts on using the Backdoor Roth IRA conversion, and actually walks you through the steps, showing you the tax forms that you need to fill out, and actually walking you through the entire process. So if this is something you're interested in, feel free to just Google. There's a lot of good guides. The White Coat Investor, I think, is one really good resource if this is something you're interested in. A couple things to note about retirement kind of savings. I know a lot of you are kind of academically inclined, like the research aspect. There was a lot of work done around defaulting people into saving for retirement by automatically enrolling them into retirement savings at a certain level, like a 3% contribution rate, and also auto-escalating, meaning that every year they would raise the contribution rate from 3% to 4%, 5% up until a certain cap. At a broader scale, this worked really well, and you can see from the early kind of 2000s, kind of the percentage of employers who offer this, and also from kind of Madrian and Shea from 2001, which is one of the classical studies around auto enrollment, looking at kind of what happens in participation in retirement accounts for those before auto enrollment was offered and then after. And it's been one of the greatest success stories from behavioral economics around the power of nudges and defaults. But what I do want to call your attention to is what I call the anchoring trap. And let me build this out using kind of some other classic examples. And this I pulled from a 1998 Harvard Business Review article, but with underlying academic research. Some of you may know kind of the power of suggestion. And in this kind of decision-making article, they talked about anchoring. And the question they asked was in two separate versions. One group was asked, is the population of Turkey greater than 5 million? And another group received the same question, but was asked, the comparison point, is the population of Turkey less than 65 million? And then the second question was, okay, now that you've told us, whether you think it's greater than 5 or less than 65, give us your best estimate of Turkey's population. And what may surprise you or not surprise you is that depending on the anchor, whether it was 5 million or 65 million, people's answer to the second question was heavily dependent on that first question. If they were asked, is the population greater than 5 million, their best estimate was 11 million. If they were asked, is it less than 65 million, all of a sudden their best estimate shot up to 65 million. Why do I bring this up in the context of saving for retirement? If you think about, I'll give you my favorite response there is, people who just didn't have internal consistency with, kind of with their answers. Why do I bring this up though? When going back to this auto enrollment, the modal auto enrollment contribution level was 3% of your salary. And there's a lot of reasons to why I think that they started at 3%. But what I would say is this: if the default or kind of the anchor is 3%, a lot of people will say, oh, well, I've been defaulted at 3%. That's probably the right level. I'll leave it at that. Going back to my kind of rule of thumb for you of saving 10 to 15%, 3% is not enough. Even if you get 100% match on that, you're only up to 6%. So I think the auto enrollment has been a huge success, but I think one of its failures has been that it auto enrolls at too low a contribution rate. And I don't want you to be anchored by that contribution rate of 3%. And so if you happen to be auto enrolled, don't be kind of anchored by that 3% contribution range. Know that you can and should aim higher than that. And again, you want to get to 10, 15%, at least, kind of in a year or two. But I think this this is one of those situations where there's a lot of benefits to, that point of auto enrollment, but there's a few downsides. There's some recent research that came out that actually played with the contribution rate and actually found that there isn't much of a drop off if employers raise the auto enrollment contribution rate to 5, 6, even up to like 8%. So, I think hopefully in the next decade or two, employers will come around and start raising that minimum rate. But I don't want you to be anchored by what you're defaulted into. Okay. So for those who attended last week, these are the two kind of recap slides. I talk a lot about, starting to save early and putting money into these retirement accounts. Ultimately, you're going to want to invest the money that's in the cash that you put into different investment vehicles. And just to recap, at the end of the day, different types of investment choices have different levels of risk. If you open up or you have a credit union account, you have a checking or savings account, that's low, if not no risk. If you're under the FDIC contribution limit of kind of $250,000, you're covered even if the bank goes under. As you start moving to the right, there's a little bit more risk that different kind of investment choices have, and I would put things like cryptocurrency, all the way to the right. The reason this is important is that the longer your time horizon, and I would put retirement contributions as probably, retirement savings is probably the longest term or one of the longer term items, the more risk you can afford to take. And so for a lot of you, if you're in your 20s or early 30s, starting to save for retirement, when you're putting together your portfolio of what you're taking the money that's in your account and kind of purchasing, I would really recommend that you take more risk because you have more time. And more risk for me means investing more in stock-based mutual funds or ETFs. Again, if you are able to watch the session from last time, we'll go into that in a lot more detail. But I do want to emphasize that retirement savings, you have a longer time horizon now, and that means that you should be taking more risk to give yourself more of a chance of kind of that rate of return being much, much higher. As you start to get closer to retirement, you will want to change the allocation in your retirement portfolio to be slightly less aggressive. So you see kind of, let's say right now is your portfolio all the way on the left, heavily weighted towards stock-based mutual funds, a little bit in bonds. The closer you get to retirement, the more you'll want to kind of skew towards bond-based mutual funds. Now notice that even if you're very close to retirement, it's not 100% kind of a 180-degree swing to bonds. You still want to have some, kind of percentage of stock-based mutual funds, but there is kind of a healthy and gradual decline in how much of your retirement portfolio should be in stock-based investments. Now, there are several ways that you can do this. Every year or every 5 years, you can go to your retirement account, you can sell some stocks and rebalance and kind of shift more of it to bonds. That takes a little bit of effort, takes a little bit of know-how, and may not be something that a lot of people want to do or kind of spend time on or feel comfortable to do. One option that I like to call out is a lot of the investment management companies who essentially sponsor kind of the accounts, whether it's through an employer or on your own, have an option to invest in something called a life cycle fund, or now it's often referred to as a target date fund. This is a one-stop shop investment, option for people. And basically what it says is target date refers to the target date of your retirement. So you may see that a place like Vanguard, maybe you go and open up an IRA there, you'll see Vanguard will have a list of target date funds, and they jump up in 5-year increments. So you may see target date 2035, 2040, 2045, et cetera. That year is referring to the year you're expected to retire. So and what you do is you find the fund that has the closest year to when your expected retirement date, and that's where you put your money. So, maybe for a lot of you, you're planning to retire in 40 years, maybe you pick a target date 2060 fund. Now, the benefit of those target date funds is they automatically shift the stock bond allocation within kind of within your portfolio to get less aggressive on stocks as you're getting closer to that target date. So you basically outsource the whole process of having to readjust and rebalance your portfolio. Companies will charge a little bit for this. I think that the incremental cost is well worth not having to deal with this, not having to worry about it, think about it. I think everyone is pretty busy. And if this isn't kind of something you enjoy doing, outsourcing it to kind of a company, I think is a really good way of doing it. So I like to kind of call out that option. So maybe more recent than Seinfeld, I like to also kind of show a clip from John Oliver, who will echo a lot of you'll see my advice around retirement. And this is both from, I think I would say, the session to today, and for those of you who participated in the session last week on investing, this will bring in a lot of the principles from there. So let's go ahead and play this.
The point is, the best advice most experts can give you is to do 5 things. Number 1, start saving now. In fact, start saving 10 years ago. Invent a time machine, use it to go back and start saving money. Then, kill baby Hitler. Next, average people like you, and let's face it, you're very, very average, should probably just invest in low-cost index funds and leave it alone. You should check on it about as often as you Google whether or not Gene Hackman is still alive. About once a year. And he is! He's still alive! He's writing novels now. Third thing, if you have an advisor, ask if they're a fiduciary. If they say no, run. If they say yes, but they're wearing a tacky Super Bowl ring, run. If they say yes, but they're wearing a class ring, run. That has nothing to do with this. I just think it's very strange when a grown man is wearing a class ring as a fiduciary. Number 4, as you get older, gradually shift your investments from stocks to bonds. Here's a way to remember it. Every time they pick a new James Bond, gradually switch more of your stocks into bonds. Then go back to wondering if Daniel Craig is actually attractive. What do you think, Doris?
Oh, he's so handsome.
No, he's not. He looks like a blonde chimpanzee in a tux, and you know it. Ugh, I wish this was Veep. Finally, try to keep your fees like your milk under 1%, because just like interest compounds, so do fees. And even 1/10 of 1% can really f you. Like this. Oh shit, Kristen, watch out!
What?
All right, good kind of combination of advice from a slightly funnier source than I could ever do. So I want to talk about one other kind of piece around this, and then I do want to open it up for questions. There is another kind of retirement, semi-retirement account that I think is worth mentioning. It's called a health savings account. Essentially, this is something that's offered if you have a high deductible insurance plan. And a health savings account, you can put money in, you can use it that same year to pay for health expenses. And the money comes in pre-tax, like an IRA or 401k. But health savings accounts are also sometimes called a stealth retirement account. And the reason for that is that you can actually, you're not required to use the money that year, like something like a flexible savings account or an FSA. With a health savings account, you can actually roll the money over every single year. You can take the account with you if you leave your employer. And the beauty is you can actually invest the money in it that's in a health savings account in the stock market. And the benefit of this is kind of threefold. One is the money that goes in is tax deductible. The money grows tax deferred, meaning you're not paying taxes. And then if you use it for qualified medical expenses, when you withdraw the money, you actually take it out tax-free. So think about it. Money goes in pre-tax. It's kind of like a 401k. Money is withdrawn tax-free if used for qualified expenses. That's kind of like a Roth account. This is kind of referred to as a triple tax advantaged account. If you're using it for the qualified expenses, you're saving pre-tax and kind of post-tax money. And so it's almost like the best of all worlds. It's sometimes referred to as a triple tax advantage account. Fidelity did a study. The average medical expenses for somebody in retirement are about $260,000. And so this notion of, having to pay for qualified medical expenses, a lot of us will unfortunately have that. And so thinking of a health savings account as a kind of stealth or health 401k, I think is a great way if you're looking to kind of add contributions along the way. You can also, kind of pay, it'll save you money as you go along. The one thing I'll say is, you have to have a high deductible plan. That has some benefits, some cons. Lower monthly premiums, you're able to contribute to an HSA, but a lot of times it has a higher deductible. And so you have to pay some potentially more money out of pocket right away. So just something I like to kind of call out for folks to kind of remember. If you have maxed out your 401k and your IRA and you want to put more money away, a health savings account is a really, really good option to consider. Let me just jump as I've done in the past. I mentioned some of these before. If this is kind of, piqued your interest in retirement or, kind of where to think, just providing like a set of resources depending on your favorite way to consume, whether it's books, websites or blogs. I also called out the White Coat Investor, which I think is a great blog, whether it's for backdoor, Roth IRAs or other ones. And there's a lot of other really, really good ones. You'll see that the advice is probably very similar to kind of the main ones that I gave you here in terms of the mechanics of starting to save early, kind of making sure that you are maximizing the employer match. What you heard it from the John Oliver video is investing in very low cost items, like low cost index funds. There was a question that had come up, kind of even before around my thoughts around real estate as kind of a retirement investment. Look, I have a couple thoughts. I think the best way to invest is to invest in low cost index funds is the core part of your retirement savings. It gives you flexibility. It's easy to, kind of cash out if you need to sell, not a lot of problems. Real estate, I can think of in two different ways. There's, if you own your own home and are thinking of accruing kind of equity there as a retirement plan, or kind of, investing in investment properties. I would say this, if you own your own home and you're working towards paying off your mortgage, that is usually the biggest source of equity that people have. The big question then becomes, though, what do you do when you need to access that money? You can take out like a reverse mortgage. You could obviously sell and downsize or kind of move. And so there's a lot of different components there around, how you actually tap into the money that's in your home. And, that's something that probably goes beyond the scope of this session, because there's, depending on whether, each of those situations you want to do, there's a lot of complexity and a lot of individual nuances that you want to consider. But my kind of general rule of thumb is the main source of your retirement savings, should be concentrated in, an investment account that has low cost index funds to use. So that would be kind of the kind of point that I would make. One request for all of you before I open it up for questions, and I'll put this in, just as an answer to everybody. We take feedback extremely seriously, and also think about it as a way to pay it forward. We tweaked sessions, for this year based on feedback from last year, and think of it as paying it forward to students who will hopefully participate next year. If you can it'll take you 3 minutes at most to complete the survey. I just sent out the link, as an answer to a question that came up. It'll take you three minutes. It's a couple open-ended questions and a couple, just how would you rate the survey, kind of how would you rate the workshop, recommend to a friend. Would love if folks are able to kind of answer that. It's really useful. So what I'll stop and kind of pause here. I will go back to the first slide just so folks have my email address as well. But what I'd love to do now is just open it up for for questions. So I see one that came in. Can we get access to the slides for this and last week's presentation? Yes. What I'll do is I will send Raven a PDF of the slides for this week, and I think she has it from last week, and she'll email that out to all the folks who registered. along with a recording from the session. So you'll have that as well. My one actually two kind of notes on the slides. One, I request that you don't share them, beyond the scope of, people in the program or enrolled at Hopkins, partially because, material gets outdated a little bit quickly in terms of the thresholds to contribute, things like that. And I want to make sure information is, pretty current. To just remember that, remember that point about information being current, and, next year, income levels for contribution rates or other pieces may change. So just make sure that you're constantly looking for updated information. But I appreciate that question. So let me pause here and kind of see any other questions that I can kind of answer for folks about retirement and saving for retirement. Hopefully this gives you a good kind of foundation, but I'm happy to kind of answer any other questions that folks have. Let me just stop sharing and see if anything comes in. Okay, question came in. What is considered a low-cost index fund? Are you talking about the price you buy the index funds at, or a low expense ratio? Great question. And I'll give a little bit detail here. This is covering a lot of detail in the investing one. So when I say a low-cost index fund, I'm referring to an expense ratio. It's basically the cost that you have to pay every year, to the company that offers that index fund. So for those who didn't join last week, an expense ratio is basically the way that mutual funds and index funds are priced, or kind of the cost of it. So you may see an expense ratio of 0.1%. That means that you are paying 0.1% for every dollar that you put in every year to the company who's kind of managing that fund. You may see expense ratios expressed either as a percent, or sometimes you may see it in something called BPS, which stand for basis points. So you may see something that says this index fund has an expense ratio of 20 bips. The way to think about bips is 100 bips is 1%. So 20 bips is 0.2%. My general rule of thumb on expense ratios is you want to keep them under 50 bips or 0.5%, and ideally under 0.2 and 0.3 bips. Vanguard, Fidelity, a lot of their low-cost funds can go down to even 0.04% or 4 bips. Target date funds I've seen usually in kind of a 20 to 30 bips ratio. So when I'm talking about low-cost index funds, I mean ones that have an expense ratio definitely below 0.5%, but ideally below 0.3% or 0.2%. All right. One other question came in, which is, I'm an international student. What would you recommend for a person that might not stay in the US? I'm looking for something with flexibility so I don't have to keep contributing if I have to go back home, or that I can contribute very light in the future once I'm no longer in the US. Great question. I think this is one that comes up a lot. A couple of considerations for you to think about. One is, if you're a national student, you're thinking about going home. The key question I would also ask is, what are your options for saving for retirement back home? If you are, let's say, in a Scandinavian country with a really solid, kind of retirement system and kind of safety net, you may, kind of feel that you're going to have a lot of money coming to you in retirement. You're not as worried. If you're in a country where you don't have that strong of a safety net, that's going to lead to a different outcome. The way that I think about it is this way. 1 second, sorry. I think it's still worthwhile to contribute, kind of to retirement while you're in the US. For one is this: if you are lucky enough to work somewhere with a match, you're just getting extra money. And so the only way to get that extra money is if you're contributing there. And so my recommendation is, even if you're planning on going back, home right away, if you are getting a match, take advantage of that. Once you reach retirement age, it never hurts to have extra money there, and especially kind of more money as it grows. But the other thought is, if you feel comfortable and pretty set in your decision to go home, and you feel like you are in a country that has a pretty strong safety net, then you may not want to contribute as much. And I think that that's completely okay. And so, if that's the situation, then, maybe it's, contributing up to the match and then stopping, or if there's no match, saying, you know what, I'm actually going to focus my money elsewhere. So it's hard to answer, with kind of one answer that applies to everybody, but my general rules of thumb would be, I would still save a little bit up to the match, and then I would think about the trade-off between, like what country you're going to in terms of how much you can expect and how robust of a retirement plan you have there. The only other factor to consider is a lot of times in the US, you can get access to pretty low cost investments, right, by contributing through your employer or, afterwards. And so I don't quite know the plans that exist in most other countries. I can tell you when I did open up a plan overseas, the expense ratios were much higher than anything that I saw in the US. And so that may be another reason to say, while I have access to contributing in the US, I may want to take advantage of that. It's a great question. One more question. For the Roth IRA account, you mentioned there isn't any penalty for withdrawals. Does that mean that I can withdraw all the money I earn in that account, or is it just contributions? So great question. So the government wants to incentivize you contributing to accounts, but they also want to kind of force you to keep it in. So I'm going to first talk about both types of accounts. With an IRA, an individual retirement account, if you withdraw money, any money in there before age 59 and a half, with a couple exceptions, there is a penalty for withdrawal. Those couple exceptions are if you're in a real hardship, and it's something called a hardship withdrawal where you don't pay the penalty, or you can actually withdraw, I think it's up to $10,000 for a first-time home purchase without paying any penalty. On the Roth IRA side, there is no penalty for withdrawals regardless of the age, but that is just your contributions. So let's say you contributed $1,000 and you started earning money on that, and a couple of years later it's worth $1,500. So you basically made $500 on that. You can withdraw that $1,000 that you had contributed without any penalty. But if you start to withdraw the earnings on it, that $500, that you would be paying a penalty if you withdrew. So the penalty-free withdrawals on a Roth are just the contributions that you put in. Hopefully that clarifies. Now, look, there are definitely situations where you may say, I really need the money and pull it out. Even though there's no penalty, I would strongly recommend, not looking at withdrawing money from a Roth IRA as a first, second, or third option, as a source of money. I would treat that money as out of sight, out of mind. And unless you are really in a tough spot, I would really try to avoid withdrawing from it, even if you're not paying a penalty. The reason is going back to that kind of first couple examples around the savers and the Seinfeld example. You're essentially withdrawing money, you're preventing all that, preventing that money from compounding and growing exponentially, and you end up paying a penalty indirectly, even if you're not paying it directly. That's a really good question, though. All right. Any other questions that folks have? Let me just ask again. I see a couple of responses coming in. If you're able, and maybe I'll put the link in again. If you're able, I would really, really appreciate if you could just take a few minutes to provide feedback. Knowing if you're anything like me, best time to do it is now, because if you don't do it now, you're going to forget to do it a little bit later. And I know that we would all appreciate that. So I sent the link again as just an answer to the question that came in from Mark, but would really appreciate if you could answer that. I don't see any other questions. So what I'll say is this: thank you again for attending. Thank you for the questions and for your engagement. Remember, next week we will have the session and a deep dive on taxes. So if you're curious or kind of struggling with how to fill out your taxes as a grad student, definitely attend that one. Otherwise, thanks again. I hope you have a great rest of your evening and hope to see many of you next week.